You could be one of over 2 million people missing out on thousands of pounds in free cash from the government every single year, as according to HMRC's own data, 2.3 million people in the UK aren't claiming their full pension tax relief. And this is because no one has explained how the system works, so they don't realise they're entitled to it, and the tax man is in no rush to tell them. And I'm not talking about dodgy loopholes or complicated schemes. This is part of the basic UK pension system, and it's money which should have been in your pension or in your pocket right now. And in this video, I'll show you exactly what this hidden relief is, how to check if you've missed out, and how to fix it if you have. And don't think you're safe if your pension is through work, as I've worked with loads of people in that exact situation who assumed payroll's handling it, but it wasn't. Hi, I'm Toby. I'm a chartered financial planner, and on this channel, I explain how money really works in plain English. Pension contributions are meant to be tax-free. In other words, the tax you'd normally pay on that chunk of income is either added to your pension, kept out of HMRC's hands altogether, or returned to you later. And that's called tax relief, and we're all entitled to it. But between 2016 and 2021, a staggering £1.3 billion went unclaimed. To understand how much tax relief you should be getting, you first need to know how much of your income normally goes to HMRC, because that's the part that's supposed to either end up in your pension or come back to you. Here's how tax works. If your total income is under £50,270, you pay 20% on anything above your personal allowance. Earn more and you'll pay 40% on the next chunk and 45% on anything over £125,140. Now let's take a £1,000 example. If you just take that as income, you'd pay £200 tax at basic rate, £400 at higher rate, and £450 at additional rate. But if you put that £1,000 into your pension instead, that same money gets redirected either into your pension or back to you later. Well, that's the theory, and that's how it's meant to work. But more than half the time, it doesn't, because there are two different ways of contributing to a pension, and most people don't know the difference. One gives you the full tax relief automatically. There's no forms, there's no action taken, it just happens. But with the other, it needs you to do something, and no one tells you that. So if you don't know, you don't act. If you don't act, you lose the money. With this second method, everyone gets at least basic rate tax relief of 20%. That bit is automatic, but higher and additional rate taxpayers are supposed to get more. What's the rest of a tax that you paid? And if you don't claim it, you don't get it. All that extra money which should be going into a pension or back into your pocket ends up staying with HMRC. Now, to understand how this happens, let's look at the two different systems a little bit closer, because this all depends on how your pension is set up. The first method is simple and only available through your workplace, and it's called net pay. Here, HMRC never takes the tax in the first place, as your pension contribution comes straight out of your gross salary before the tax is calculated. You've got £1,000 as gross salary, and it goes straight into your pension. So the real net cost you is whatever would have been left in your take-home pay after tax. Whether you're a basic, higher, or additional rate taxpayer, the full tax relief just happens. Now, the second method workplace pensions use, and it's also a default one for all personal pensions, is called relief at source, and here's how it works. You get paid, and tax is deducted, and then your pension contribution is taken from what's left. Your provider then adds back some of the tax, and those are the key words for this whole video and the problem: some of the tax. Because your provider doesn't know your personal tax band, they only apply basic rate tax relief to make sure that no one gets too much. For our £1,000 example, you pay in £800 and provider adds £200, and that's the basic rate relief. Standard, automatic, done. And it doesn't matter whether you're basic rate, higher rate, or additional rate, everyone gets the same £200 added. But that's where it goes wrong, because if you're a higher rate taxpayer, you should be getting another £200 in relief. If you're an additional rate taxpayer, £250, but you only get it if you reclaim it. Your provider doesn't do it. Payroll won't fix it, and HMRC, they won't tell you. Unless you personally reclaim it, you don't get it. And that grey chunk on a chart, that's what you're missing month after month, year after year. Thousands of pounds just left behind. And over the decades, it can easily build into tens of thousands of pounds, maybe even more. So here's what to do. First, find out what kind of scheme you're in. Is it net pay or relief at source? And if it's a personal pension or SIP, it's definitely relief at source. If it's workplace, you need to ask your employer, HR, or the provider. Don't make the mistake of assuming. And second, work out your tax position. If you're above the high rate threshold and using relief at source, you're owed money. And third, reclaim it. If you do a self-assessment tax return, you can add it in there. If not, you can contact HMRC directly and request a refund, and you can normally go back up to 4 tax years. This isn't about gaming the system. This is about fixing something that was supposed to work but often doesn't. So check it out yourself and share this with someone you know. Don't let thousands of pounds just slip through your fingers. And if you found this helpful, hit the like button and subscribe for more of my content. And if you want to see how another pension decision can impact your life, watch 5 reasons you should take your pension tax-free cash, and I'll link it here. Thanks for watching.